Do you have an asset selling in 2025 or 2026? Now what? You see, if you've invested in an equity asset like a multifamily building, self-storage, anything like that, you have a hidden risk because if you've taken depreciation, which most of us, that's the whole reason why we invest in real estate, the IRS actually may want some of that money back, that depreciation, even if your deal lost money. Now, we are going to tackle this topic today, but most investors actually over rely on the operator to track all the numbers when in reality, the operator is just managing the financials. It's up to us, you and I, as the investor, to do our part with our CPA team to arrange our affairs as such to lower our impact from depreciation, recapture, and capital gains. So we are going to talk about that today in our episode of the Passive Investing Made Simple Masterclass, where we're going to talk about depreciation and recapture decoded, how to track your K-1 activity so you can protect your gains at exit. Now, we do this masterclass every Tuesday to help you learn the ins and outs of passive investing. So maybe you've tried to get comfortable making a passive investment before, but you just never got there. Or you actually invested in a deal and went, oops, it didn't align with my goals. Or you're a seasoned investor and you want to deepen your skills and knowledge base. If that's you, you're in the right place. We're going to teach you how to turn your active income in savings into passive income and long-term wealth. Now, if this is the first time you and I are meeting, my name is Whitney Elkins-Hutten. I'm the Director of Investor Education here at PassiveInvesting.com. And I've been investing in real estate actively and passively since 2002. And the whole reason why I do it is to scale my income so I can have 100% choice on how I spend my time. And how I spend my time, I love traveling with my crazy crew here, pictured on the screen. We love doing everything outdoors, nationally, internationally. But what allowed me to get here was actually scaling that portfolio. Now, I was never a high income earner. I actually had to build my equity through active investing in real estate. And then I learned how to turn that equity into long-term cash flow and long-term wealth. Now, I actually teach people how to do that here at PassiveInvesting.com. So you should also follow my journey in my book, Money for Tomorrow, How to Build and Protect Generational Wealth. And if you want to learn more, if you want to connect with me, if you want to discuss your investing goals and how we can help you here achieve those goals, be sure to connect with me at PassiveInvestingWithWhitney.com. There, you get access to a one-on-one call with me, additional free education to help you build your skills and build your passive income, as well as comprehensive investor resources. Now, let's get into today's topic. With any webinar that you see on social media, it is for educational purposes only. Okay, nothing we say here is financial advice, tax advice, legal advice. So make sure you take all this information back to your investing team before making a decision. Now, we opened up today's webinar with the question, do you have an asset selling in 2025 or 2026? If you do, let's get ahead of the game. Okay, let's start arranging our affairs as such. Okay, so we can lessen our tax liability impact, because if it's an equity asset, Uncle Sam's going to want a little bit of their money back. All right, and we'll explain why that is. It's not a penalty, but we'll explain why that is. But if you are one of those investors that are just like, nope, I'm going to do everything in reaction, I'm going to wait until the asset sells to move my chess pieces on the board, you might end up with an unexpected tax bill. Or you might realize that you've actually left some deductions on the table that could have helped you out. Or you might realize, oops, I'm actually partnered with the wrong accounting partner here. And if I had just had the right tracking strategy and had asked the right questions of my accountancy team, I would have figured that out. I could have saved myself thousands, tens of thousands, maybe even hundred thousands of dollars. It's not just taxes that is the opportunity cost here. Okay. When we have poor planning, when we miss these deductions, that is an impact to our velocity of money. All right. So I'm going to teach you how to do that today. We aren't going to calculate your tax bill. That's not what we're here to do. We're not here to play a side chair CPA. We're here to give you the tools so you can remain educated and partner with your CPA to get the answers that you need. All right. So before we can actually start decoding depreciation recapture, we actually have to understand what depreciation is. Okay. Depreciation is the IRS's way of recognizing that a building wears down. So you and I are investors. We either buy our own building or we invest in a project, and the IRS knows that we as an investor need to keep that building in repair. So as opposed to like giving us free money to repair the building, they give us a tax deduction that we can take every year that lowers our income that we are taxated against. That is called depreciation. All right. It's actually an expense line item. The IRS assumes that we take depreciation whether we actually claim it on the form or not. So for those investors, if that's you, okay, if you have never taken depreciation on any of your projects, guess what? You're going to be subject to depreciation recapture because the IRS assumes that you're taking it. All right. So to back it up, that as a real estate investor, you get to deduct a portion of the property's value every single year if the property's, even if the property is going up or down in value, you get to take that deduction. This creates a paper loss that can actually offset real income on your 1040 form. Okay, but when you sell that, okay, the IRS will want to recapture some of that tax loss benefit. Okay, and we'll show you, and it's not 100%. They're not going to take 100% back, right? They're only going to take the portion that you overdrew on. Okay, all right, so accounting methodology number one, depreciation. All right, when we're talking residential real estate, essentially that's if we have $1 million purchase and 800,000 of that is improvements like the building, the fencing, parking lots, whatever, landscaping. All right, that all can get depreciated. Now, we can either say that all that improvement value is $800,000. If it's a residential building, we can divide that by 27.5 years and just take it equally every single year. If it's a commercial building, we can divide that by 39 years. That would be like industrial, self-storage. All right, but we can actually switch our accounting methodology and take accelerated depreciation. All right. So in order to do this, we're going to talk in terms of multifamily asset just to kind of narrow down our scope, right? But you can tangentially move these skills around to other assets like self-storage or industrial. Multifamily operators will perform what we call a cost segregation analysis. They engage an engineer, and that engineer technically goes in and studies the building, and they say, okay, this much of the value of the building was attributed to land, this much is the value attributed to improvements. But not all improvements break down equally over time, right? Your carpet in a multifamily building is going to break down sooner than the foundation or the roof, okay? So the IRS has given us a scale, right? They have put things in categories, things that break down in 5 years, 10 years, 15, 20 years, 27.5 years, okay? So through this study, it allows us to take whatever breaks down in about 20 years or less, and we can fast forward that to the first 5 years of the project. And so say that $800,000 improved building, we actually do a cost segregation study, and it is determined that 500, let's make the math easy, 500,000 of that is attributed to items that would break down in 20 years or less. So we can take that over the first 5 years of the project, equally $100,000 every single year, okay? Why would we do this? It's because we can create larger paper losses earlier in the hold period, okay, that can offset passive income not only on that project, but other projects we have in our portfolio, and it creates a time value of money, okay? The tax deduction today is worth more than 1 in 10 years from now, right? So if you have investor number one does the accelerated depreciation, and investor number two chooses not to and divide it 20 or the depreciation over 27.5 years, investor number one is going to create more time value of that money because they're sheltering their income tax-free. All right. It's a strategic move. It is an accounting methodology switch. Now, I don't have a slide in here on bonus depreciation. Bonus depreciation is simply a tax credit. It is not an accounting methodology. So there's just a tax credit in place called bonus depreciation. And right now it's at 100% in 2025. So instead of taking that $500,000 of accelerated depreciation over the first 5 years, $100,000 every year, now we can take all $500,000 in year one. We're creating super velocity with our money through tax losses. Okay. Now, the IRS goes, wait a second, Mr. Investor, Mrs. Investor. If you took all that depreciation and now you sell the building, um, you weren't entitled to that. You shouldn't have taken that until like year 10, 15, or 20. So whatever you took that was attributed to the year that you sold, cool. But whatever you over withdrew on, or overtook, over banked, we need that back. Okay. So that's where depreciation recapture steps in. It's the IRS's way of reclaiming the tax benefit when a property sells. Okay. It's not a penalty. All right. If you will, as an investor, you get to keep the tax benefit you were entitled to for the years that you held it. But if you accelerated depreciation earlier in the project, now you kind of get some of that back. Now, a lot of investors think that this is a huge penalty. They kind of freak out a little bit. But here's the thing. We're going to walk through, one, how to track it, two, how you can arrange your fares as such to minimize the impact. But three, recognize this. If you sell the property, okay, and you over withdrew on those losses, we got to, the IRS is our business partner by giving us the depreciation. We do kind of owe the money back, right? We borrowed money from quote unquote from the government in order to be able to keep the property in repair. Okay. When we are subject to depreciation and recapture, it is technically taxed at ordinary income. Okay. Now, depreciation recapture happens when we sell a building and the IRS reclaims some of the depreciation tax benefit. I was just on the phone yesterday with an investor who was looking at selling 5 properties, almost all of which he'd held 4 years or longer, upwards to 10 years. And he was wrapping his head around, like, I owe all this depreciation back. And I'm like, no, you only owe the delta of what you were entitled to. But if you over withdrew, that's what is going to get recaptured. Okay. Now, depreciation recapture can apply whether you received a loss in cash or just on paper. So we'll walk through a couple scenarios where you can actually sell a building for a loss and be subject to depreciation recapture. Okay, there's a couple, tweaky things there where it can happen, but generally, depreciation recapture is only going to apply to those buildings that are sold at net neutral value or greater. Okay, just think of this. Let's put a pretty bow on this definition. Depreciation recapture is a clawback on the tax break. It is not a penalty. It's just how the system works. But if you're unaware of it as an investor and you don't plan for it, of course you're going to be blindsided. Okay. But remember, it's not always owed. We can actually arrange our fares so we don't owe it. All right. So let's get a little more granular. What actually gets clawed back? Okay. So we already mentioned that depreciation recapture technically only applies to the property sold at a gain. Okay. But that is not actually a good definition. I hear a lot of people say that. Let's get more granular. It's limited to the lesser the depreciation claim or the gain on sale. Okay. So if you've been doing 1031 exchanges into properties, okay, kind of kicking your tax can down the road, I'm going to show you what happens when you do that and you sell and you decide to exit, okay, as opposed to dying with that property in place and passing it on to your heirs and allowing the step up in basis to wipe out your depreciation and your capital gain. Okay, so you could actually have a property sell for a loss, but because you 1031 exchange into it, your depreciation is lower and you actually get depreciation recapture. Okay, depreciation recapture can be broken up in 2 different areas. Okay, actually, I'm not an accountant. There's probably more, but 2 main areas. One, What is the structural depreciation? Okay, that's recaptured at 25%. And then what's the attributed to personal property? Okay, that is going to be taxed at ordinary income rates up to 37%. Now, here's the thing. You, as an investor, get to arrange your affairs as such in order to lessen your tax liability. Okay, so it doesn't necessarily mean it for you, it's 25% or 37%. Okay, it's just that's where we're starting at. Okay, that's the starting line. Now, another kind of statement that I hear often is that if a property sells at a loss, there's no recapture. In theory, that could be true. But remember, if we 1031 exchanged into a property, our basis is lower. And so now that probably isn't true anymore. So remember, the depreciation recapture is limited to the lesser the depreciation claimed. Okay, and remember the IRS assumes we claim it or the gain on sale. All right, so again, how do we manipulate the lesser the depreciation claimed? Okay, that's going to be our accounting methodology. Whether we took inline depreciation, just divided it over 27 and a half years, or if we actually performed that accelerated cost segregation analysis, took accelerated depreciation. Okay, now this is where a lot of investors actually their heads kind of explode and they're like, oh, well, then why on earth would I go into a project that did cost segregation analysis if it could be all of that could be subject to depreciation recapture? It's because you're looking to create time value of money, not just within one project, but within your entire portfolio. Okay, and that is super valuable. And we're going to talk about how that passive loss flywheel actually can protect you. Okay, so number four, you can use suspended losses, okay, on other projects to help reduce or eliminate your tax hit on the project that is exiting. Okay, this is where, much like I coach single family investors, multifamily investors, people getting into their first or second buildings, um, don't just buy one building. Okay, don't just do one passive investment. Let's get multiple going over time so you're constantly building up that bucket of losses. So as your projects exit, those losses can help wipe out the tax bills that are occurring. All right. So this is a quick, bare bones visual on depreciation recapture. So let's say we bought a building originally for $300,000. Okay. Initially, we took $100,000 of depreciation. Okay. Yeah, I just picked a random number. Our new basis in the building is $200,000. Okay, because 300 minus 100 is $200,000. Now, we fast forward a couple years later, we sell the property at $400,000. Okay, so our gain is $200,000. Now, on paper, right now, the math is mathing that 400 minus 200 means we've got $100,000 going to be attributed to our depreciation recapture, and then $100,000 then is technically our gain. But remember, that's just our starting point. Okay, we get to arrange our fares as such that we can reduce, use other passive losses, use other, expense losses in order to reduce these numbers as much as we possibly can. Okay, and we can use losses from other projects that we have currently in our portfolio. But the only way you know what's happening here is through tracking. So that's where we're going to go into our system here in a second. So let's talk about three main ways you can actually reduce your recapture as a passive investor. Okay, one, 1031 exchange, right? If an operator is exiting an asset and if they're able to, if it's the right part of the market cycle and they can find an asset and to 1031 exchange to, you could participate in that next asset. Okay, you just stay in the LLC for the property that's selling. That LLC now moves into the new project. Okay, that's a great way. We're kicking our tax can down the road. But remember, when we do 1031 exchanges, we're continuing to lower our basis. Okay, so technically our delta on recapture is getting bigger and bigger and bigger. So we need to kind of stick with the borrow, buy, die strategy. Buy, borrow, die strategy there. Okay. Rely on that step up of basis to wipe everything out. Okay. That's an extremely powerful strategy. We can also on 1031 exchanges, if you're selling your own, say, multifamily building and you have $1 million of equity, you could do a 1031 exchange or what we call a tenant in common into like a multifamily project or a self-storage project. That is a viable way too to eliminate your depreciation recapture. Uh, Again, we've already mentioned this several times. You can, as a passive investor, you can use other suspended losses within your portfolio, but you got to be tracking these. Your CPA needs to be on the ball with this. And sometimes our team member, our CPA isn't. Or you can offset with capital losses from other assets. Now, that's not a good strategy because it means we actually had a loss in another asset. We don't want that. But if you are coming out of the past, couple years, I know I have a couple losses in my portfolio. And I always say it's not a matter of if, but a matter of when, right? If you're continually investing, eventually one deal is going to go sideways, maybe a little south. But if you have a loss, that can also help wipe out depreciation recapture on a particular project. You may not control the sale of the asset, but you can control how you prepare for the exit. But you got to know your losses, track your basis, and ask the right questions. So let's get into this. Our three-step process here that we're going to cover really quickly is how do we track our K-1 activity? How do we track our portfolio activity? And then how do we ask strategic questions, specifically of ourselves and our CPA? So tracking our K-1 activity, I want you guys to take a screenshot of this here. We did an amazing webinar with our Director of Finance, Tal Brody, end of last February, 2025, understanding your K-1. She showed us how to track our K-1 losses, our depreciation, and our capital count. That is a super powerful webinar for you to watch and follow. So I'm just gonna kind of like let you guys go there, take a screenshot, find this on our YouTube page at passiveinvestingdot.com. But on a high level, what Tao showed us in that video is a simple spreadsheet that we can put together to track our depreciation taken in box 2. Okay, for this particular project, 50K was depreciated in 2021, 15 in 2022, 5 in 2023, 1 in 2024. Okay. Also, how to track our classification distribution. Okay, in this case, the distribution was out of box 19. And so this particular investor got $8,000 a year of cash flow. Okay, and then $100,000 at the end of 2024 because that was they got 8,000 in distributions for 3 years and then $100,000, which was their original capital they put into the deal. Okay, and then she showed us how to track our capital account. Okay, so very powerful here. Now up here, I do want to draw distributions box 19. That was the cash distribution plus the $100,000 capital returned. And then this investor got another $95,000 gain on sale. All right. And then down here, we're tracking our capital account, $100,000 invested. Okay. 50K minus 8K gives us 42, right? And we're just tracking our capital count and our income losses over time, all right? And then we actually, at the end, we calculate what our overall gain on the project was and our net cash distributed. Okay, this is important information. Now, this chart alone does not tell you depreciation recapture is imminent. It doesn't. We have to wait for the final K-1 on the project, and you take that back to your CPA in order to get that question answered. But if you're tracking this, you actually can see, is the project gaining money, right? Especially upon exit, like, what is happening on sale? You can actually see if the project's selling for a gain, net neutral, or for a loss. And that's going to be your first clue on whether depreciation recapture is going to be triggered. Now, remember, it's not just what happens on the one project. The most powerful thing you can do as a passive investor is to track all your depreciation over all of your projects. Okay, because if you're gathering all your K1s and you're looking at your portfolio as a whole, remember you might have other passive losses within your portfolio that can help offset gains on a property at sale. Okay, so make sure you're tracking all your K1s, you're tracking this portfolio wide, and then you are kind of eyeballing carry forward losses year to year, and those should generally match with what your CPA is tracking too. Okay, so this gets us to our third step. You have to ask strategic questions. Don't rely on your CPA to guess what you need to answer these. You need to bring them specific data. So here's some just questions that I thought off the top of my head. This is stuff that I ask myself every year. When a project is exiting, have I tracked the activity? Do I have a general idea if it's being sold at a gain, loss, or neutral outcome? What portion of my distribution was a return of capital versus return on capital? Okay, that might actually impact your taxation as well. That's noted in the PPM. You know that at the beginning. So go to your PPM and figure out if your distributions were a return on capital or a return of capital. Did you take the depreciation? So all operators are going to actually bank on your K1, the depreciation. That K1 should be handed over to your CPA. So when we have an investor ask us, hey, am I going to get depreciation recapture? We don't know if you took the depreciation or not. Okay. If you didn't, maybe not, right? Like, maybe the CPA can do something for you. Maybe you didn't take the depreciation in the past years. Maybe you need an amended return. So sometimes it can be a really clouded answer. But ideally, if you are working with a CPA worth their salt, they're going to take the depreciation for you. They should be doing that. Remember, the IRS assumes you're doing it. Was this deal involved in a 1031 exchange? So this deal that's exiting, did you 1031 money into the deal? Because if you did, remember, that kind of changes the game. We can actually have an asset sell at a loss, but because you 1031 into it, it's going to trigger depreciation recapture for you, but not for other investors. Okay, so again, this is all super personal. Do you have suspended passive losses on your 1040 that you can use to offset other gains? Now, you might scratch your head a little bit and go, wait, I don't know where all these answers are. I need help. Great. Take this information to your CPA, okay? And then ask them some additional questions, okay? They can help you suss through the questions that you hopefully can answer for yourself. And they should be able to answer this. How are you tracking and using my carry forward losses? Do I have suspended passive losses that I can use to offset the gains of this asset? Okay, once you kind of get all these questions at first answered, right? Everything in this column, questions for you, and these first two over here. Now the question can be asked, will this trigger, the sale of this asset trigger depreciation recapture for me, and how much? Okay, so and then if you can qualify as a real estate professional, okay, you might be able to unlock additional depreciation to help you out here within your portfolio to actually keep other active income, okay, tax levered, okay? And then what other passive gains or losses my portfolio should be considered before sale, all right? So those are some strategic questions. Now, sometimes I run across an investor that was like, I don't know if my CPA is ready to tackle all these questions with me. Okay, that to me is a red flag. So here's something, this is like kind of a three-step way that we can kind of suss out if our CPA is the person that we should be partnering with here to help us figure out our tax situation. One, ask them to explain depreciation recapture. Can they do that? Can they clearly articulate what's happening there? They can't, that's a problem. Okay. Do they know and are they providing to you your carry forward loss report? For my CPA, I get a sheet on the top of every one of my tax returns that is a summation of one, tax moves that I can do for that year, for the next year in order to lessen my tax liability, but also summation of my carry forward losses because that's part of my tax strategy. Okay. Now, you should be tracking your losses year over year. I would keep those, notated on a spreadsheet. because if you ever switch CPAs and those numbers move radically, you're going to want to know why. Okay. If you move CPAs, or if you're working with a CPA to put together your taxes and they never ask for all your K-1s or your full K-1 history, that's also a red flag. And especially if you have moved CPAs, they need to be asking for that entire K-1 history, because that is going to allow them to help, one, make sure that the CPA before didn't make any errors, and two, help you strategically tax plan moving forward. Okay, if they're not asking, they're not planning. All right. So here's kind of my catch-all question. Does your firm specialize in passive real estate taxation strategies? If they say no, okay, that tells you everything. You can even follow this up. If they say yes, how many of your clients invest in passive real estate? Okay. I would want to see probably 40, 50% or more of their clients investing in passive real estate. All right, let's put a pretty bow on this. Your next steps is one, go back and watch this video. Okay, you now had the definition of depreciation recapture, how it gets triggered, what happens when it actually is triggered. And now you have a framework in order to work through to understand what's happening within your deal and how that personally applies to you. You now have a strategy to take action, not only to track your investment, to partner with your CPA to get your questions answered in real time. And remember, as always, most investors don't plan, but that's not you. That's not why you're here. We are planners, okay? We are going to save ourselves thousands or hundreds of thousands of dollars and not pay unnecessary taxes because we missed a deduction. All right. If you want to learn more, if you want to connect with me, be sure to go to passiveinvestingwithwhitney.com. There, you and I can jump on a one-on-one call, discuss your investing goals, heck, maybe even discuss depreciation recapture too. You get additional education from us and then exclusive priority access to our open deals. If you're here live, don't go anywhere. We're about to start our Ask Me Anything part of the show.